Hi, I'm Roger Montgomery and welcome to this week's Video Insight. Now, some of our recent posts, articles and videos may border on the too technical, but don't worry. Our job is to help you pick up the principles we adhere to at Montgomery and take you on the investment journey with us. Rather than being elite, we prefer egalitarian. So with that in mind, I thought I might chat with you about how the slowdown in the Chinese real estate market can impact your shares and property investments here in Australia. As we've described here at the blog before, property prices and construction are already well off the boil in China. The slowdown will have far-reaching implications for Australia's unemployment rate, our real estate prices, and the profits of some listed companies. So you should be really interested in what happens next. Now, a casino is perhaps the best metaphor to describe the key players in the Chinese real estate game. And to answer the question of what happens next, we need to know who the players are, who hold the cards, and who might capitulate and fold their hand first. The three players are quite simply the investors, and I use inverted commas because, as you know, they're not investing, the developers, and of course the government. Now, you might think I'd like to include the banks, but I won't because they're being driven or directed by a higher force. The government has instituted several curbs on real estate speculation already, and perhaps the most significant and less talked about is the anti-corruption drive. Now, with government officials and their relatives accounting for a shocking 30% of real estate buyers, they don't want to alert officials to any practices that might see them detained or worse. And these curbs are already having an effect. Real estate transactions and construction accounted for almost 13% of GDP in 2013 and more than 15% of GDP growth. So the slowdown is believed by many developers to be an effective incentive for the Chinese government to re-stimulate the economy. At this stage, however, the government is showing no signs of capitulating, and we've heard from a friend that the government has in fact told steel mills to cut back all excess capacity to a bare minimum level that does not affect employment. As an aside, that's why we believe you're seeing iron ore at $91 a tonne and on its way to $80 a tonne. So developers are holding firm too. They're not reducing the prices of their properties at which they're willing to sell, and as a result, they're seeing their inventories rise as they bet the government will loosen liquidity again. But of course, developers can't hold for very long. They've got the highest carrying cost from holding, and so we think they're likely to capitulate first. And the impact, of course, is going to be even lower property prices. That brings us to the investors, a descriptor I use loosely in a market where buyers don't rent out their properties for fear of blemishing them. The bare fact is that much of the rising market was buoyed by short-term trading and speculation, and with prices pulling back, there are simply fewer of them left. That means less liquidity. Falling prices is also resulting in the wealthiest Chinese moving or diversifying their assets overseas. London, California, and here in Australia are the most preferred destinations, and you're now seeing Chinese outbound investment compete with first home buyers and those investors taking advantage of low domestic interest rates. It's interesting, of course, to see that Chinese outbound real estate investment is now up 80% from the same period last year, and I, for one, think we're going to see it even higher. In this game of Texas Hold'em, who blinks first will likely therefore be the developers. They're going to have a cash flow problem in a few months because they've got 14 months of supply already. A broader sell-off in property is likely in the third quarter of this year. That's what we think anyway. And that brings us to the question of whether the government then steps in again as they did after the inventory build-up in 2012. Of course, if they don't, the ripples are going to spread beyond developers to local governments who depend on real estate sales for 60% of their revenues. In turn, the economy in China will slow further while Beijing weans the local governments off the real estate gravy train. For Australia, where the Bureau of Resource Economics already expects resource projects to fall in value by 75% by 2018, the impact is far-reaching. A larger number of people looking for jobs and competing with people who have already lost their jobs in manufacturing and tourism. As you're already aware, we know there's no correlation between economic growth though and the stock market, so don't go rushing out to press the sell button just yet. Think instead about what a slowdown in Chinese real estate means for local interest rates. If they stay lower for longer, it could mean even higher asset prices. That's all from me this week and this week's Video Insight. I look forward to seeing you again next week, and in the meantime, be sure to follow us on Facebook and Twitter.